Hi everyone, welcome back to my YouTube channel. This is Raz, and in this video, we will continue our discussion about allowable deductions, particularly losses, as an itemized deduction against our gross income. If you're ready, let's start. So we will start this video by defining what is a loss. A loss is an amount of money or money's worth lost by a business or organization. A loss could occur in the following circumstances. First, when deductions claimed exceed the revenues. So we have been discussing about itemized deductions, about allowable deductions, and when these deductions exceed the gross income of the business, therefore there is a net loss. That loss could be allowed as deduction to our gross income in the next year, which we will discuss in our other videos. Okay? Also, a loss could occur when a property is destroyed in a casualty. So, for example, there is a storm, or there is a typhoon, or there is an earthquake, okay, or robbery, or fires. So, these casualties, those acts of God, which by the way we cannot control, could have a significant impact on our properties, and these properties could be lost or damaged. So, any losses arising from casualties could also be claimed as deduction against our gross income, provided that the properties lost are connected to the taxpayer's trade or business. Okay? Or when the property is stolen. For example, someone inside or outside of the organization stole the property, or robbery. These robbery, theft, are considered as acts of men, and we can actually prevent those theft by imposing internal controls, like putting CCTV, or having a stricter internal controls, or any physical control that we could keep our properties from robbery or being stolen. So these losses that I have been talking of covers the following scenarios. First, those losses arising from casualties. Next, we have losses arising from operations, and also losses arising from wash sales, which we will explain in the other video, and then abandonment losses. Also, we will discuss about losses from gambling. So these are the 5 losses that we will be discussing in this topic about losses as an itemized deduction against our gross income. But since these topics are too long to discuss in one video, we will divide this topic into 3. In this video, we will discuss the losses arising from casualties. In the other video, we will discuss the losses arising from operations. And in the third video for losses, we will discuss the losses arising from wash sales, abandonment losses, and also the losses for gambling. So again, in this video, we will focus our discussion on the losses arising from casualties. Okay, so let us talk about the general rules when claiming losses as an itemized deduction against the gross income of a taxpayer. As a rule, losses actually sustained during the taxable year and not compensated for by any insurance or other forms of indemnity shall be allowed as deductions. Again, any expenses or losses or taxes or interest could be deducted from the taxpayer's gross income, provided that these items are ordinary, necessary, and substantiated. When we say ordinary, these items should be connected with the taxpayer's trade. These should be usual and not unusual. Okay, when we say necessary, these items should be needed, should be necessary in the conduct of the operation. And when we say substantiated, meaning there should be evidences that supports that these items or expenses or losses are really incurred in connection to the taxpayer's trade, business, or practice of profession. But in this case, as a rule, losses to be deducted from the gross income of the taxpayer should not be indemnified or compensated by any insurance. For example, if the taxpayer's property is damaged by typhoon and then there is an insurance to cover that damage, then the losses arising from that casualty is non-deductible because the losses is actually covered by the insurance. So we can only claim losses as a deduction from the gross income if these losses are not covered by any insurance or indemnified by any insurance. These shall be the rules when claiming losses as a deduction from the gross income. First, the property or the loss should be incurred in connection to the taxpayer's trade, profession, or business. Also, the losses should arise from fires, storms, shipwreck, or other casualties, or from robbery, theft, or embezzlement. And take note of this, no loss shall be allowed for deduction if at the time of the filing of the return, such loss has been claimed as a deduction for estate tax purposes in the estate tax return. So when claiming losses as a deduction for income tax, always remember that you have not double claimed these losses, meaning you have not claimed these losses in other tax returns. If you are filing for estate tax return at the same time an income tax return, you can only claim these losses in either one of them and not both. So if your losses is, let's say, incurred in relation to your business, then maybe you can claim that losses against your gross income when filing an income tax return. But if the losses are incurred for the properties of the decedent or the estate of the person who died, then maybe those losses could be deducted for estate tax purposes, which we will discuss in our future videos. Okay, so again, you cannot double claim any loss. You can only claim a loss in one of the return. So now let's talk about the requisites when claiming losses as a deduction from the gross income. A taxpayer claiming losses as a deduction from its gross income must concur the following requirements. So these are the requirements. First, the loss arise from fires, storms, shipwreck, or other casualties, or from robbery, theft, or embezzlement. The property lost is connected with the taxpayer's trade, business, or practice of profession, and the loss is actually sustained, and the loss thereof is ascertained during the taxable year. So these losses to be allowed as deduction must be actually sustained. This must not be anticipated or estimated. For example, if you are an investor in stocks in the stock market, and then you see that you are losing your money because the prices of the stocks where you invested in is dropping down. There is no actual loss in that since you did not realize any loss at all. That loss is only a paper loss, an estimated loss, or unrealized loss. Okay, so those unrealized losses arising from changes in fair values or selling prices, especially in stocks or properties, those losses cannot be deducted from our gross income. The loss should be ascertained and actually sustained by the taxpayer. And also take note that the loss is not compensated for by any insurance or other forms of indemnity. If compensated with insurance, only that portion which is not covered by insurance may be deducted. So if, for example, the insurance coverage is not enough to recover the loss, then that certain portion which is not covered by insurance is only the amount to be deducted from our gross income. Okay? And the loss should be reported with the BR or to the BR within 45 days from the time of loss. So always remember, when you actually sustained a loss, this loss should have been reported to the BR within 45 days after the discovery of the loss. Okay? And these losses should not have been claimed as deduction for estate tax purposes, as I have already discussed earlier. Since this video is all about losses arising from casualties, let us illustrate a scenario where there is a loss arising from a casualty. So there are losses arising from casualties such as floods, typhoons, shipwreck, theft, and other forms of casualties. Actually, just this weekend, the Philippines is hit by the typhoon Rolly. So, as you see in the news, a lot of people lost their homes, their businesses, and even lives of their loved ones. And not only that, another two storms are coming into the Philippines and they follow the same path as Rolly. So, as expected, there will be a lot of families who will really suffer from the typhoon. A lot of business will really suffer from that. Not mentioning that we are also suffering the COVID-19 pandemic. So anyway, again, as I have said, losses could arise to business or to taxpayers when there are casualties like floods, typhoons, shipwreck, theft, and other forms of casualties. So this is something that we cannot avoid, especially those casualties which are acts of God and we cannot control them. So we are given here as an example, the asset lost was a capital asset, and we have already discussed in our other videos what a capital asset is. So the cost or adjusted basis or the depreciated value of this asset was 18,000 pesos. The value of the property, which is a capital asset, before the casualty was 15,000 pesos. And the value of the property after the casualty is now 10,000 pesos. And there was an insurance recovery from the loss. So we are asked, how much is the deductible loss? So in this case, since this is a capital asset, the rules on capital gains and capital losses applies, especially if this taxpayer is an individual taxpayer. How do we compute the loss in this particular case? So in this case, the capital asset was not sold but destroyed by casualty. In our previous video lectures, we have discussed the capital losses arising from the sale of capital assets. But in this particular scenario, the loss sustained is not from the sale of the capital asset but destroyed by a casualty. We shall account the loss based on the difference between the value of the property before the casualty and the value of the property after the casualty. So the cost or the adjusted basis will not matter because the property is not used in business. Thus, allowance for depreciation does not actually apply. So since the asset is a capital asset, we know that this asset is not used in business. Therefore, this asset should not be depreciated. The taxpayer should not record depreciation because this asset is not used in business. So we will not use the adjusted or cost basis. Instead, we will use the values of the property before and after the casualty. Okay? So the value of the property before the casualty was 15,000 pesos. And the value of the property after the casualty is 10,000 pesos. Therefore, there was an actual loss sustained on the capital asset. And that is 5,000 pesos. Okay, so this is the loss that the taxpayer sustained from the casualty, assuming the property was a capital asset. However, since there was an insurance recovery, we will deduct the insurance recovery from the losses to get how much was really lost from the casualty. When we deducted the insurance received, the 3,000 pesos, we will get a deductible loss on capital asset of 2,000 pesos. So this is now the deductible loss on the capital asset. However, the rules on holding period still applies if this is an individual taxpayer. But since we are not given whether this taxpayer is an individual or corporation, we cannot ascertain whether the holding period really applies. Okay, however, remember, if it is given that the taxpayer here is an individual taxpayer, therefore you should apply the holding period, meaning you should determine when was this property acquired. Was it 12 months ago or not more than 12 months ago? So the holding period should be considered when claiming losses on capital assets. Also consider that capital losses are only deductible from the capital gains. So in this case, though this is a deductible loss, but we can only deduct this if there is a capital gain. Okay, do not forget what you have learned already in our discussion videos about dealings in properties. Okay, so as I have mentioned, the holding period still applies if the taxpayer is an individual taxpayer, and the loss computed can be deducted only if there is a capital gain. And also, the rules on net capital loss carryover applies in this scenario. But again, we cannot ascertain whether this taxpayer is an individual or a corporate taxpayer. So let's have the second scenario. The asset lost was an ordinary asset and there is a total destruction. So when I say ordinary asset, again, this could either be used in business, subject to depreciation, or an inventory, whether personal or real properties. And it is said that in this scenario, there is a total destruction, meaning the entire property is destroyed and there is nothing to salvage. There is nothing to repair because it is totally destroyed. So we are given the following data. Acquisition cost of this property, of this ordinary asset was 10,000 pesos, and the accumulated depreciation was 4,000, and the insurance recovered is 2,500. How much is the deductible loss? So it is actually simple and plain problem because there is a total destruction. So it is expected that there is nothing to salvage or to repair. So what we're going to do here is just to compute the book value of the asset. And the book value is 6,000. That is acquisition cost less accumulated depreciation. So we have 6,000. So that book value of the asset is totally destroyed. That is the loss, actually. But since there is an insurance recovery, we will deduct that insurance recovery, the 2,500. So here's the computation of the loss. So acquisition cost, 10,000, less accumulated depreciation, we have 4,000. So we have the book value of the asset lost. So this book value of the asset lost, this is actually totally destroyed. So therefore, this must be the loss. However, since there is an insurance recovery, so we will deduct the insurance recovered. So that is 2,500. So in short, we have a deductible loss for a total loss of the asset of 3,500. So this loss, since it arises from the casualty and the asset loss was an ordinary asset, therefore this loss could be deducted from our gross income from ordinary gains. Unlike capital losses, which can only be deducted from the capital gains, ordinary losses can be deducted whether there is a gain or not. So again, this loss is an ordinary loss. This is deductible in full from our gross income. Okay? So the holding period and the rules of net capital loss carryover do not apply to ordinary assets because again, the NCLCO and the rules of the holding period applies only if the asset involved was a capital asset. So that is when there was a total destruction or there is nothing to salvage or repair. So how about if there is only a partial loss or when the asset, an ordinary asset, is not totally destroyed? So in this third example, the asset lost was an ordinary asset, but there is only a partial destruction. So when I say partial destruction, meaning the asset is still there, it's not totally lost, it can still be repaired, it can still be brought back to its original form, but it will take amount to repair the asset. Okay? So there is only partial destruction. So we have here the acquisition cost of the property was 100,000 pesos and the accumulated depreciation was 90,000 pesos. Therefore, the book value of the property is 10,000 pesos. The replacement cost to restore the property, when we say replacement cost, this is the amount to repair or replace the property to bring back or to restore the property to its original usable form. So the cost given is 20,000 pesos. So again, this is the amount that the company or the taxpayer should spend to bring back to the property to its original normal operating condition. while the insurance recovery was 5,000 pesos. So the estimated remaining useful life after the repairs would be 5 years. So after this asset will be replaced or will be restored to its normal operating conditions, the estimated useful life of that asset would be 5 years. And we are asked here, how much is the deductible loss? So the first step here is to compute how much is the book value of the property. Then we will compare that book value to the amount that the company should spend to repair or to restore the property. Okay, so in this case, there is only a partial destruction, which means that the property can still be repaired back to its normal condition. The acquisition cost was 100,000, less accumulated depreciation, we have 90,000 pesos. So therefore, the book value of the asset lost was 10,000 pesos. This was the book value of the property before it was destroyed by casualty. However, after the casualty, we need to spend 20,000 pesos to restore the property back to its normal operating conditions. And we will compare this book value, the 10,000 pesos, to the amount, replacement cost, or the amount that the company or taxpayer should spend to restore the asset. So we will compare these two figures to determine whichever is lower, because the loss should not exceed the book value of the asset. In this case, assuming there was a total destruction like what we had in our previous example, we know that if there is a total destruction, the entire book value of the property should be treated as loss. Okay? But in this particular scenario, when there's only partial destruction, it is said that the asset could still be repaired back, could still be restored. So if the taxpayer would spend 20,000 pesos, therefore that is actually the loss there. When the taxpayer would have to spend, that is the loss actually. So the loss here supposedly was 20,000 pesos. Okay, this is actually the loss that the taxpayer actually sustained. However, our law does not allow losses to be deducted if such loss exceeds the book value of the asset. Like in this case, the actual loss sustained is actually 20,000 pesos. This is the loss that the taxpayer incurred when it repaired or restored the property. So this loss, since it exceeds the book value of the property, this loss cannot be deducted in full. We can only deduct the loss equivalent to the book value of the property, not the 20,000 pesos. Okay? So when the replacement cost is higher than the actual book value, the lower amount, the book value, may be claimed as deductible loss, because the deductible loss cannot exceed the book value of the asset, as what I have said already. The deductible loss, therefore, is only 10,000 pesos. Again, the loss, the replacement cost, could not exceed the book value of the property. However, since the company spent 20,000 pesos to restore the property, it means that it only benefited 10,000 as a loss out from the expenditure of 20,000 pesos. If you will imagine this, the taxpayers would spend 20,000 pesos to restore the property, and then it can only deduct 10,000 pesos as a loss from its gross income. Therefore, it only shielded, or the taxpayer only shielded himself from the payment of income tax for only 10,000 pesos, even though the actual loss there is 20,000 pesos. Okay, so there's only 10,000 tax benefit instead of 20,000. So therefore, in that case, we will split the replacement cost, one, to be deducted from our gross income, the 10,000 book value as the loss, and two, the amount to be capitalized added to our asset. Okay? So here's what will happen. The replacement cost to restore the asset was 20,000 less deductible loss, the tax benefit, that is 10,000 pesos. This is the money spent but not claimed as deduction. So again, as I have said, from the entire 20,000, we can only deduct the 10,000 as our deductible loss from our gross income because the loss could not exceed the book value of the property. So therefore, the taxpayer spent 10,000 more, and these 10,000 more could not be allowed as deduction from our gross income. So we will deduct also the insurance recovery, and that is 5,000. Therefore, the net amount of money spent and not allowed for deduction was 5,000 pesos. So for the taxpayer's behalf, he is losing money because he spent 15,000 as a net amount, net of the insurance, and then only 10,000 was allowed for deduction. So he is losing money. So what we're gonna do here is to add this 5,000 to the book value of the property, and we will have a new cost basis of this new restored property. Remember that the book value property was 10,000. We will add the 5,000 not allowed for deduction to that book value, and we will depreciate that 5,000 for over the remaining estimated life of the property. So this 5,000 again may be capitalized and treated as an asset since it is capitalized on the account of the property. The 5,000 pesos shall be depreciated over the remaining useful life of the asset. Okay, so again, in this scenario, there was a partial destruction and the extent of deductible loss is only the book value. You might be wondering, what if the book value is 10,000 and the amount needed to spend to restore the property is only 7,000. So how much would be the loss? So again, the loss there, since it could be restored, is only limited to the extent of that restoration cost. Okay? If the restoration cost exceeds the book value, only the book value is deducted from our gross income. But if the restoration cost or replacement cost is lesser or lower than the book value, then that amount, the lower amount, could be deducted from our gross income. Okay, so that's it. That's how we treat losses arising from casualties. Please watch the other videos that we have about losses arising from operation and wash sales, abandonment losses, and losses from gambling. Okay, so thank you so much for watching, and if you're new to this channel, please subscribe and click the notification bell so you'll be notified whenever I will upload new videos. Thank you so much for watching.